This is the Cardiff Business School podcast, where we explore the power of public value in everything that we do. My name is Peter Wells. I am the Pro Dean of Public Value within Cardiff Business School. And my guest today is Professor Arman Eshraghi. Arman, welcome.
Thank you, Peter.
Yeah, it's a real pleasure to have you here. And we've had a diverse array of guests come along to these podcasts. I think you're another really good example of the sort of person that's thrived under our kind of public value umbrella, but perhaps in an area of academic work which is not traditionally associated with some of the values that we seek to nurture and create. And these are the sort of things I think is worth exploring with you today. There's a couple of aspects to your work which I think are good to highlight. One is how incredibly productive you are. What drives you? What is it that makes you want to... You've reached so many different audiences in so many different ways. What is it in you that makes you want to be like that?
Well, thank you. Thank you very much for the kind words, Peter. It's a tough question. So to me, the ideal of a well-rounded academic, a well-rounded professor who can contribute to many different facets of the role. So not just producing research, but also teaching at the highest level possible in creating impact for students, for executive audiences, engaging with the media. Another thing I do is editing journals, which also takes a huge amount of my time.
Yes,
but
indeed.
I've been enjoying that. So I guess there is this sort of mental image of the professor that I'd like to achieve, and I've been trying to get there. That image is not a monoblock. It's really a rather nuanced, complicated array of activities that I believe academics should aspire to. And thank you for your compliments.
No, it's interesting because years ago, somebody joined the school and became a professor and said to me, I'm trying to decide what sort of professor I should be. And that's an interesting question because, of course, it's a role that has a multiple of interpretations.
Indeed.
And your interpretation has been a very kind of strong one in that sense. And you've looked to reach a great many different audiences. And I'm wondering, how does that happen? How does that work? Are you just simply approached, and the more you do, the more you get approached? Do you deliberately seek out different types of audience, different themes?
It is a combination of both. There are opportunities that come our way, and sometimes you're more proactive at seeking them or grabbing them. And then there's also the cascade effect of perhaps doing something well, and then you're invited to do more. So I guess, for example, with keynote speeches, you do one or two, and then they like how you connect to the audience, and then you get more and more invitations. So there is a self-fulfilling prophecy in that. But overall, again, I believe it is also self-fulfilling in a sense that the more you do, the more you feel enriched and fulfilled as an academic and as part of this wonderful community of Cardiff Business School. So I'm very honored to have been on that journey.
Yeah, it's interesting, isn't it? I think you get that immediate feedback, which you wouldn't get writing an academic paper.
Indeed.
All you get is a lot of criticism in the first instance,
Very true.
which you have to respond to. And then if you eventually get it published, then sometime later it may be cited, we hope, which is a rather dispassionate exercise.
You're quite right, absolutely. And there are obviously new mediums for disseminating research. For example, a couple of years ago, I did a TEDx talk.
I saw that, yes.
So that one, it was sort of warning against financial hype of certain technologies. And anyway, that sort of 17-minute talk reached, or let's say it was viewed by something more than 200,000 people on YouTube. And I thought, wow, this is great. Because I think
something, isn't it?
if I pile up all my published papers, probably the technical readers are not going to be as many. So so it's really kind of nudges you to think maybe we should also consider and be more open to other forms of disseminating our thinking, going public, YouTubing. So your podcast, in fact, I know is being viewed by many and has the potential to go even wider. So thank you so much for creating this series of conversations with such a diverse range of
Well, this is the thing. There's been all sorts, including proper, fully fledged professors. So yeah, it's been good. But of course, it's one thing to want to reach out that wider audience, but it's another thing to have something kind of interesting and meaningful to say to them.
Absolutely.
And I think this is really the key to why I think your work has been so interesting, because this area of kind of behavioral finance is relevant at all levels. It's relevant kind of at the macro scale, thinking about these major kind of financial flows and how countries deal with issues and so on. And yet it's also relevant. Well, it's relevant to me, thinking about I'm trying to invest my money into a sustainable investment trust or whatever. How is that going to work? Is it going to work? Should I be doing something else? These are all questions we all face. Well, many people face. Indeed. So what is the message you have for kind of lay people about finance that can help?
Absolutely. So let me preface that with a bit of personal story. So when I started my PhD, it was 2007. So just the outset of the financial crisis.
Well done.
So it came,
we don't blame you.
So roughly 20 years ago, and I came up with a different proposal. But then through how the events turned out, and the banks, you remember, the banks started to collapse and all that.
Yes.
And in conversations with my former PhD supervisor, we thought, this is actually even more interesting to think about how financial crises emerge and how they play out, and what's the role of psychology in all of this. And behavioral finance obviously was at that point a relatively new idea, not brand new, but relatively new. There was still quite a bit of resistance against it. So it was a bit of an uphill struggle.
Was it the idea previously that financial decisions were purely kind of objective?
Yeah. So the short form version of behavioral finance is that originally the thinking was that people are strictly rational in a very strict technical manner, which means they're attuned to maximizing their utility all the time. They never make mistakes, even if they have some biases here and there. In the bigger scheme of things, they don't matter, and then they cancel each other out. For example, if Peter, you're a bit overconfident, maybe Arman is a bit underconfident, so overall it plays out and cancels out, and it doesn't matter. And markets are always right, and the price is always right. So that was the sort of original thinking. But then behavioral finance came about and said that actually people have very structured biases. Doesn't mean they're irrational; it just means they're human. So.
It's an interesting distinction.
Yeah, so it's sometimes oversimplified as saying that people are irrational, but they're not. They try to make the best decisions with the limited constraints, with the limited resources they have. We have shortage of time. We have plenty of information to go through. So it's a difficult process to get to optimize our decisions. But of course, we're emotional. We're short-termist. Yeah. So markets. In the short term, in the midterm, they move a lot based on investor sentiment of the market, which is the sort of weighted average of how bullish or bearish I might be. There's research showing that, for example, the kind of music you listen to on your way to work might impact your financial decisions, or the weather, obviously, the sunshine, the length of the sunshine hours within a day. So that all of that has been established. But I guess the sort of school of behavioral finance became more and more established through these crises that we saw, and it never went out of fashion. The more sort of cutting edge version of it these days is what's called social finance, which actually puts more emphasis on the social relations between people and how, for example, rumors spread, how what you do, Peter. For example, if you tell me, I bought this stock and I'm very, very convinced that it's going to, make me a millionaire within a couple of weeks, then I might be tempted to go and buy the same stock. Right. So sentiment obviously has always had a social element to it, but in recent years, through the spread of social media, information and disinformation obviously moves and travels at very, very high speed. Yes. And this is, of course, we've seen so many examples of that as well. Again, for example, in the world of cryptocurrencies, you can see that rumors are spread about a particular crypto asset or token, and then suddenly A lot of people go and buy it. And usually the majority lose out. The very first few who might pump and dump it might be the winners, but the overall there's
pump and dump it is obviously a technical expression.
Indeed. So inflate exactly. So they kind of jack up the prices and try to hype it up.
Right. And then sell when...
Absolutely. Yeah. So behavioral mechanisms basically in financial markets have been around as long as ever. But in the past couple of decades, they've been really well studied, much better understood. Mm-hmm. So that's why the discipline of behavioral finance is now very well established. We don't have to sort of fight the critics anymore, and it's sort of taken for granted now. And now we're looking at applications of it in different areas. So so going back to your question, my key message is, as you know, household incomes are obviously declining in real terms in many countries. In the UK, of course, in Wales, we're dealing with living costs issues. Basically, we are at the mercy as individuals. We are at the mercy of so many external events which are beyond our control. Right. Geopolitical events, Russia, Ukraine, I don't know, if ship gets stuck in the Suez Canal. There's so much we can't do. But what we can do is manage our hard-earned pounds and dollars and euros in the best way that is possible. And that message of that sort of lesson of financial literacy is, I believe, within that, behavioral finance plays a very, very important role.
Okay.
Because it's not just about teaching formulas in mainstream econ and finance 101. It's actually trying to educate people on how the mind works when it comes to managing money, investing, how to take a long-term
risk. Yes.
And the importance of time and taking the long-term view, the patient view to financial markets.
So this is often the advice, of course, that you invest into these funds for a long time. But how long is a long time? In trying to kind of convey that message, how does it sit alongside, say, the computerized purchasing and selling?
Yeah, so this is where the challenge is, because especially I think right now with Gen Z and subsequent generations, everything is sort of dopamine driven, click, get an immediate reward. So I think that sort of thinking is quite dangerous when it comes to financial decision making, because what financial history teaches us is that if you're patient in financial markets, first of all, the sooner you invest and the sooner you save, the more the rewards through accumulated, but also taking the long-term view and not trying to take short-term profits out of the markets, especially when the markets are jittery. So that's important, which is why, if you allow me, I want to introduce my prop.
So go for it.
So I brought this hourglass here.
Beautiful hourglass.
Yes, it's a bit faster than you might want, actually. What I like this to connotate is the importance of time in making financial decisions. So what you really want is to take that long-term view. In fact, we have a shortage of patient capital in financial markets, even at the institutional level, because fund managers, they have to show immediate or relatively short-term results to their investors. Imagine you're investing with a fund manager and the fund manager says, okay, I've parked your money in some companies which I think are going to do really well within the next 5 years. You'll probably be asking, but then why am I paying you every month or every quarter?
Good point. Well made.
So there is this hunger for short-term returns. But in reality, the advice from financial history, from behavioral finance is go for long-term returns, look at fundamentals of companies and try to take the long-term view. And this significantly reduces the risks. It significantly reduces the risk of mistiming the market because we're not very good. Again, this is psychology, actually. We're not very good at timing the markets. And because of what's known as loss aversion, we hold on to losing assets for too long. So if you bought some stocks and they're going down, often we're tempted not to sell them because not to cut our losses because we think, okay, maybe they will rebound, right?
But isn't that the lesson of investor patience?
Absolutely. So the advice is to take the long-term view and hold on to them. But the problem is most people sell at the worst time. So when it's sort of really
at the bottom of the
exactly,
cycle.
and they lose their patience.
Right.
So if you're that type, the advice would be to cut your losses early on and move on. So,
okay.
But the problem is we always want to sort of take shortcuts as humans, as individuals, and we want to create opportunities for riskless profits. And
I am going to have to make sure that my 15-year-old son, Nicholas, listens to this podcast. Because, of course, in his generation, they are acutely aware of all of these issues around them. They see people, influencers getting wealthy overnight. They see people trading in Bitcoin or whatever.
Yeah. It
seems like miracle money.
Yes, indeed.
Nicholas's main aim in life seems to be, I want to be a passive investor.
Well, that's nice. Actually, that's the sort of advice we're giving. Going with passive investing significantly reduces your risks on a risk-adjusted basis. There's nothing wrong with active investing, though, of course, but you have to be mindful that you could lose that. The amount of invested within a short time frame.
It's an interesting area because one of our members of staff here, Mirella, her expertise is in gambling and how addictive gambling can be and so on. And there's a fine line between, it seems to me, active investing and gambling.
Oh, yes, absolutely. And it's interesting you mentioned that because there's a whole category of stocks called lottery-type stocks.
Oh, really?
Yes, they have the same attributes as lottery tickets. They're low priced, right? So because a lottery ticket is $1, $2, so they're low priced, but they're very volatile in terms of their price movements and other statistical attributes, which make them very similar to lottery tickets. And so research shows that the same type of people who gamble in casinos are also inclined to invest in these kinds of or trade these kinds of stocks. So exactly. So if there was to, obviously I'm not a financial advisor, qualified financial advisor, but research shows that it's better to avoid those, or at least if you're getting into them, know exactly what you're getting into and the risks involved, because that's very, very important. And there are a lot of innovations in markets which are also hyped up. For example,
such as,
okay, so for example, right now, AI is the craze, right? So everybody talks about AI, and there's almost no conference without mentioning AI these days.
You had some early papers in this field, I noticed.
we did a bit on that, exactly. And my colleague and I here, we have a PhD student who's looking at AI hype. So this is, for example, all the companies that speculatively mention AI or even change their names to something AI related, and then their share price moves on immediately.
With no substantive
changes, exactly. So this is all cosmetic. We are creating an index for AI hype, which actually looks at all these little red flags. Because, obviously the UK is spending a lot of public money on AI for good reasons, of course. But you have to be mindful not to invest in companies which are just riding the hype train, right?
Sure.
So you want to invest in future NVIDIAs and future, for example, OpenAIs, but not a lot of others who are just, copycats or trying to simply show off without actually substantive offering. So this is very important. And so far, to the best of our knowledge, there is no systemic way or measure of AI hype in the market. So this is very new and very novel.
Yes. And quite needed.
Quite needed, and indeed. And the plan is hopefully, and in fact, our measure is sort of ready in a way. So once we launch it, we would like to talk to the regulators and to the policymakers.
Yeah, that was my next question. Yeah, because obviously this takes you into the policy sphere in a big way. And I'm wondering, how far do you see your future work in particular being more in that sphere rather than, say, thinking about how individual investors work?
I think it is inevitably going in that space. And obviously, the two would synergize each other. So research into how individuals make decisions cross-fertilizes policy impacts. But I'm very eager to continue conversations with policymakers. One thing that I should also mention is that we organize a conference every year in London, which is a sort of a collaboration between our university and a few other professors from other universities. It's Europe's largest conference dedicated to behavioral finance and longest running. In fact, it has been running for 18 years. I've been involved with it for 5 years now. And so in that conference, we bring in the best thinkers and the best minds in this area. And interestingly, we see more and more policy papers and we see more regulators attending the conference.
Right.
So,
and do you actually work directly with psychologists? I mean, have you collaborated with psychologists?
Yes, I have. I have in the past, for example, worked with a renowned psychoanalyst and psychologist from UCL, Professor David Tuckett. And
that's interesting, because your background is very different. You're engineering,
indeed,
and
yes.
then you worked in industry, and then you transmuted yourself into academia, and now you're reaching out into psychology.
Yeah, so psychology has always been one of my long-standing interests, but it became a very interesting and very capable tool to allow me to interpret some of our financial results. So I'm part of the Center for Study of Decision Making within UCL, headed by Professor David Tuckett. And in that center, what we do is, again, we really talk about things like conviction, confidence, uncertainty, radical uncertainty. Because if I may, also let me elaborate on the difference between risk and uncertainty. Because risk is
I'm all ears.
So risk, Peter, is something you can measure, right? So for example, you can say the risk of this stock going down tomorrow is 10%. But uncertainty is the unknown unknown. So risk is the known unknown.
Donald Rumsfeld territory.
Yeah. So uncertainty is the unknown unknown, and it's something you can't measure. You don't have any measure for.
Right.
How does the human mind deal with uncertainty and cope with it and understand it? And that's where psychology comes in. And there's plenty of cognitive psychology, psychoanalysis even, that can help explain how we, first of all, we're really averse to uncertainty. Most humans, we don't like uncertainty. Therefore, we prefer to have some measure, even if it's a noisy or crude measure, for how tomorrow is going to play out.
Even if it's wrong.
Even if it's wrong, exactly.
That's really interesting, because I've noticed that in my discussions around public value that in their various ways, participants have reached out beyond their original kind of starting point. And yours is a really, really good example that perhaps to create those kind of public value outcomes, we need to be more than just business scholars, in your case, more than just a finance scholar. And I'm wondering whether that is a correct analysis in your case, or whether you maybe in your situation, your industry experience, your practice experiences has informed somewhat this journey that you've embarked on. And maybe, as you go into the policy space, will that take you more into collaborating with scholars who work on policy?
I have a background in the banking sector before doing my PhD, and I started off with very quantitative models of risk management. But then the more you get on to how actually banks look at risk, you understand the models sometimes are very crude. And again, it's really sort of a mental defense against the uncertainty, because you really don't know who you're lending to or what goes on in their minds. So
it's more of a comfort factor.
Exactly.
Okay, that's reassuring.
Well, in many cases it is. Of course, the models are getting better and better, but still, there's a lot of behavioral factors which, again, going back 2 decades ago, were not factored into the lending decisions, but now they are.
Right.
And now we have AI, which helps us make more sophisticated models. So again, behavioral factors, cognitive, emotional, social factors are coming into lending credit decisions, which is reassuring, in fact. So my former experience did inform my multidisciplinary approach.
Thank you, Arman. It's been fascinating and a really interesting insight into your life, your work, and what can we say? You've made a marvelous contribution, and we're looking forward to more.
Thank you so much. Thank you so much, Peter, for the opportunity. It was a pleasure talking to you, and all the best wishes.
This has been the Cardiff Business School podcast, and we've explored with Arman today the impact of finance and financial decision-making in both everyday life for many citizens, but also in the wider picture and the macroeconomy. It's been a really interesting insight into how behaviour still matters, no matter which technologies or which innovations we're talking about in that financial space. Thank you very much.